Yeah. I know. How about that? It's a shame because they usually make fun of Detroit, and I'm always showing off how beautiful it is. And today it's beautiful, but I'm in Northern Virginia. So there you go. Not Detroit
Hey,
today.
I always say nice things about Detroit. It's just that Dr. Rick character. So Skye, welcome to Real Fridays. We're waiting on Dr. Rick, but until then, thanks for coming on. Jeremy coming in from not Detroit, you said Virginia.
Yeah, I appreciate the invite. It's good to be here.
Cool. So, Potter, what's going on in the great outdoors with you today? Or can you hear us? Not so good.
He's walking closer to a cell tower.
Yeah. All right. Fair enough. So, Skye, how's the week been for you guys so far?
Good. I was in Santa Barbara for the NBA Chairman's event to start the week. So that was an excellent event. And of course, anytime you're traveling for work, the work doesn't stop. So,
yeah, that sounds about right.
How's the fire hose coming home? So.
How big is that event?
It's a good question. I think it's about 150 people. It's pretty modestly sized, which I think adds to the benefit. It's to the benefit of the event and the conversations that are happening there. So actually, I think I was mentioning to a couple other folks in attendance, like it was one of the first events I've been to in a long time where people were willing to say things that you didn't already know, right? Where it wasn't just getting up and reading a press release or a boilerplate. There was some actual discussion happening, which is really helpful and constructive, I think.
Have you ever been to that event, Potter? NBA Chairman?
I am not. I think that is, I agree with Skye. I think the intent is, I think it's invite only. And I think that a lot of it is about, let's have real conversations that, affect the industry. So it sounds like that was a success, and definitely worth your time anytime you get the inside view, I would say. I think a lot of times there's we called this Real Fridays for a reason, Skye. And I think a lot of it was, it's easy to say the thing that everybody already knows, or that kind of situates you in the middle. And I think it's hard sometimes to put an opinion out there that, especially if it's going to potentially alienate part of the industry. And if you're a vendor, that's concerning. If you're a lender, there's really no upside for you. And so like a lot of it gets watered down. So it's nice to hear there are still some forums where you can step in, have that conversation, get maybe some more, midwinter always was that too. I think it still is, where Dave Stevens set up a midwinter conference that was invite only. And so I think that definitely helps.
Yeah. It doesn't have to be anything controversial either. It's just,
right.
Yeah.
It's
just things that you didn't know when you walked in the door. And I think, we need more of that in the industry generally, or all industries. I think where you go to events, like the content, needs to deliver value. I think so many conferences have become about the collection of people, and maybe more so because we're all remote these days. But the actual content at a lot of conferences is lacking, and I think just for that reason, because folks are kind of unwilling to step out and say anything that might be either misconstrued or just sort of strategically disadvantageous to them, to let anyone inside their view of the market or the world.
Yeah, when you go to MBA, it's pretty clear, like, the industry is the mortgage finance industry because it's the MBA and you're at a conference. When you, Skye, move around at different events, you talk to business partners, you pitch crib equity, do you have a go-to industry that you say you're a part of? And if so, like, tell us about how you would say, like, what would you say crib equity is part of? What?
Yeah, we are a blank company.
I like to think we're part of the solution, but it is a little bit amorphous. And when we first started the company, at least in the world of sort of venture financing, we were trying to steer away from prop tech because it was sort of prop tech nuclear winter, right? That was like no one wanted to kind of touch that as an industry. So then it was maybe a little bit more fintech. But I think it can go a lot of different directions in terms of the audience that we're speaking to. But we're obviously not a lender. We're not necessarily a vendor either.
Right.
We act as the sort of enabler for all sides of the transaction, for the conference we go to, talking to realtors, talking to other vendors in the space, talking to mortgage folks. I mean, we are, I think, a catalyst or an accelerant to the ability for folks to transact and buy today. And so that kind of places us squarely in a lot of conversations. And I don't know that I have a great categorization for how I would define the business by industry as a result.
Yeah, I think that's good. I mean, one of the things that has always attracted me to how crib equity works with consumers, how crib equity works with home buyers and eventually homeowners, is the fact that the liquidity doesn't have an easy comparison, right? So when you're talking to realtors about liquidity, you're talking to homeowners about buying a home, it's not down payment assistance, but it is.
Yeah.
It's not, right? It's not, you're not a lender, but you are a co-owner in many ways, in different ways. And so I kind of like that. I think it helps, and it helps to kind of unlock some assumptions people jump to, open up minds, especially on the realtor side, and say, actually, this is an option. It's a liquidity option. It's going to work for a lot of people. It's not going to work for everybody. And, really kind of go right at the fact that there isn't a great categorization. I've always appreciated that.
Yeah, it's obviously an opportunity. It is a challenge though, right? I mean, it's not as though we can go out there and market ourselves as like, the new version of Rich Parents, right? Like there isn't a market for Rich parents. People aren't going to Google and being like, where are my rich parents? Like, even though you have them or you don't, right? So it can be a little bit tricky to there's obviously some education that goes along with it because there aren't a lot of comparables. And so, that it is an opportunistic place to be, but it's also, that education takes time and energy as well. Yeah. But maybe we should create a market for around rich parents, right?
Yeah, it's funny. At Easy Knock, has some
go ahead, Brad.
Some similarities. Yeah, which has some similarities of use case, but not that many. But we always went with prop tech, and it was always a question of, or honestly at NewZip as well, my current company, is like when HousingWire is like, are you coming as a mortgage attendee or a real estate attendee? Are you coming as a vendor or an industry participant? It's like, I don't know the answer to any of those questions.
Well, usually just look at what the registration fee is, and then you can figure out your answer.
Yeah, exactly.
That's right.
We were actually pretty surprised. We got one of the HousingWire like Tech 100 awards or whatever. They do 100 real estate and 100 mortgage. We won one of the mortgage ones. Or like, well, we're licensed as a real estate company, not a mortgage company, but I guess we sell the mortgage company. I guess we play in mortgage. So feel you there. And the prop tech winter is real. We've had a lot of fundraising conversations with general VCs that have gone really well, and then with prop tech VCs that are just not investing in anything because they've been burned so bad. So I totally understand that point.
Yeah, I sort of wonder when that's going to come around. That there was, certainly on the capital side, there's, for the liquidity of our product, that conversation has changed dramatically over the last year or two. So I sort of wonder when the market will shift. I think there was this, 2022, the sky is falling, the real estate market's going to implode. It's going to be 2008 all over again. And then we've basically just had continued growth in the market since that point, right? And so I think while there's a lot of similarities, there's a lot of unique aspects to the market that we're in, and people I think are starting to look at that maybe a little bit differently or a little bit more critically around where the market actually is going to go. Yeah,
we just got a really good comment from longtime listener Mike Cush. In a market where the prime topic of conversation is whether or not buyers can now come up with 3% to potentially pay a buyer's agent commission, there's shockingly little conversation from mortgage around all of the low down payment and down payment assistant type options. We wholeheartedly agree with this. We have never had more at NewZip. One of the things we do is have is help people, get cash back out of real estate commissions. On the buy side, it's literally cash back. On the sell side, it's a discount. And we've never had more people inquiring about it. We've never had more conversation about it. It's been good, mostly. I mean, it's interesting. It's like good and bad, but it's a really good point that the down payment related topics and really where you fit with crib equity and the mechanics of your transaction isn't as frequently in the news, isn't as frequently headlined. Probably a good chance for for anyone listening that doesn't know crib equity intimately, maybe talk about the mechanics of where you fit in the transaction.
Yeah, definitely. And I think to Mike's point, he's also speaking specifically around, the idea that buyers now, or I guess very soon here, there's a date coming up where they're going to need to come up potentially with that commission up front as well, because it's not going to come out of the, necessarily by default from the sell side. And that was actually one of the topics that, came up in various conversations this last week at the event. And I think there's a recognition that is going to create challenge specifically for the groups of folks that are already the most challenged to enter into the market, because, for the same reason that everyone wants a move-in ready home, it's much better to finance those improvements over 30 years than it is to come up with cash to renovate your home up front, right? I mean, it's people are constrained at the point of purchase, and particularly first-time buyers, the ones that may be able to get the most benefit from working with a good real estate agent are going to be the ones that are the most challenged to actually find one, because you're going to see agents, I think, move to a place where they know they can get their commission, where they can lock that in maybe on higher price points with more educated buyers who have transacted before. Because I think the first time buyers may look the other way, specifically given the cost constraint. But so crib equity, just as a brief overview. So we're going at that problem of the down payment barrier for home buyers. But it's not just the down payment, it's also a DTI issue. It's a capital reserve issue, right? I mean, I think there's a challenge not only in coming up with the requisite funds to get into a loan product, but also can you put enough down to then qualify for the payment you have to carry? Obviously, with home price appreciation, with rates where they are, that's a big ask and task for a lot of buyers too. So our marketplace allows us to match investors with those home buyers to invest in a co-purchase upfront. So we can typically double, sometimes more, the cash to close that a home buyer brings. And then depending on that allocation upfront, it sets a share of the future proceeds and appreciation of the home. And so on the back end, sort of the net after all the the net proceeds that the owners would see is sort of split evenly between the two parties based on their contributions on the way in. So for us, it's sort of as I said, rich parents earlier. Like, I think we're the rich parents for the majority of folks that don't have them, because that's where the market is headed. Is that you've got to have some assistance up front. I think specifically depending on the market, right? Nationwide, 10 years to save a 10% down payment. California here where I'm at is like 17 years, something like that, right? It's a massive uphill battle. And by the time you get that saved, the house you were going to buy is now twice as expensive, right? So it's like getting on a treadmill.
Yeah, for sure. So Dr. Rick finally made it in, a mere 14 minutes late.
I know. I had a number of technical issues. I'm in a hotel in Sacramento, California, and I had to have the IT people here at the hotel try to help out with the Wi-Fi and get it moving. So apologies for being annoyingly late. That's
funny. And Potter, we can hear sometimes. He's in the great outdoors in Virginia. Either way, Skye and I are off to a strong start here, hearing about crib equity and where it fits. So you guys assist with the down payment. Is it always half? Is it, or what's the specific structure? Can you take or leave?
Yeah.
You want or need?
So some of it is determined by the investor that we're matching. Half is typically the upper bound. We do have some folks that will consider doing a bit more. So maybe if you had 7.5% as a buyer, we could get you 12.5 to get to 20, specifically recognizing the cliff there around MI. But typically it's just going to be a maximum of matching the home buyer, and the investor has this sort of subordinate silent equity position. They want to know their skin in the game too, so they don't want to put in all the down payment and then have the borrower, it's just step away at some point if things don't work out. So it can be less than that. It can certainly be, it's just sometimes we have a difficulty doing more.
And is it almost all like conventional people trying to get to the 20% down, or do you also see like do you also help with like FHA or like very, very low down payment products? I mean, VA.
Yeah, we typically look for at least 5% from the buyer, but there are a lot of folks that are in that camp, right, that may still not get to 20. Interestingly, we've also, see folks that are, already at either 15 or 20 and want to get to 30, right? Because they're looking for a different payment profile and mortgage product. And then, we see folks that are at 20 that would prefer just to do 10 because, they want the diversification. It's a lot for many folks who are saying, hey, I can go all in, but basically my home is going to be my only asset at that point, and that doesn't feel like a good position for me to be in. So, it offers a lot of flexibility, to steal some of Jeremy's words from one of our prior conversations, that buyer, it becomes the how much of your home do you want to buy product.
Yeah. Cool.
What do you, is this primarily like primary occupied, or is it investment property? Is it, because obviously there's a DSCR loan that a lot of mortgage companies leverage to help, and that's intended for, in essence, Airbnb type products or opportunities or other sort of vacation properties, and it's primarily like a 20% down type of product. But the reason why it's so attractive is they only take deposits basically as the qualifying income. So they just look at top line deposits into an account. It could be a business account or it could be a personal account, and they leverage that as your qualifying income for the particular property, and they match that with local MSA rent income that would come up. And as long as the monthly payment does not supersede the income, the rent amount, the rental collection, like it's fine. But so is that an avenue for crib equity, or is it primarily just people who want to own and live in the property they want to buy?
Yeah, I mean, to begin, it's primarily, I call it personal use, because it doesn't have to be a primary residence, but I'll say most of the investors on our platform are less interested in funding investor properties for two reasons. Like, one, obviously, that there is a desire to create access to homeownership for folks that may not be able to achieve that on their own. And the second is, say sort of tongue in cheek, like no one washes a rental car, right? And for these investors, because, they don't have cash flow, they don't have yield, they are betting on the future value and appreciation of the home. They want to make sure that someone takes care of that home and that it's well maintained. And I think there's a belief that the asset itself will appreciate better and will be taken care of to a greater extent if it's owner occupied, or at least an owner's residence rather than a rental property. So not to say that we can't or wouldn't do that, but it's not a primary focus for us today. Yeah.
Jeremy,
one of the things,
go ahead, bud.
Yes, Rick. I don't know why you kicked me out when you joined. You didn't have to do that. That was rude of you, but okay. Skye, one of the things you just mentioned that I had a question about was, words matter, and down payment's easy for people to understand, but then you start getting into these other arrangements and capital stacks and liquidity, and then it becomes difficult. So can you talk a little bit about how you've done the consumer education piece and how you're thinking about talking to consumers in a way or in terms they understand?
Yeah, it's a great question. I mean, down payment itself is fairly well recognized either. And I think sometimes maybe the people recognize they need a down payment. They may have misconceptions actually about what they need. I think a lot of people do think they need 20% when they actually don't to get a loan product. Now they may need to get to 20% today to qualify for the mortgage, just given, wherever they're at from an income perspective. So the down payment, piece is, I think, fairly well understood, that we can double your down payment. And that's inclusive of closing costs and, transaction, costs and all those things, because the party that we're bringing together is also an owner. So, it goes beyond just the down payment, maybe as for specific language. But I think the other thing that really can resonate is the reduction in the monthly payment or in the cost of the mortgage, right?
Yeah.
So if we take someone from 10% to 20% down, that can be 25% a month on their mortgage payment, and that is that's a big jump that someone can immediately recognize and consider, what that means for them in terms of their cash flow, in terms of other opportunities. And conversely, some folks are like, have come to us and said, hey, I want this specific neighborhood. I want to be closer to the city center. I want a school district. I want a shorter commute. I want amenities, and I need 15 or 20% more budget. And so I'm going to use your product to get us there. So it is definitely, again, one of the challenges we have, I think, is that we're in a position that there are multiple different options and opportunities and value statements for customers. And so kind of trying to refine that down to who we're talking to, what their actual goals are, because we can help you buy more, we can help you save money, or we can, help you retain liquidity or diversity in your own portfolio.
What's interesting, Mike Cush, and I didn't know this about his background, but he said when he was at PHH, we managed a program like this, kind of a rate subsidy in return for shared appreciation for executives of the U.S. Postal Service. And I know that, we've talked about this, a few times, Skye, where, especially in urban areas, it could be Detroit, it could be in San Francisco or other major sort of urban centers where working class, police, fire, educators who simply can't, they in some cases, you have to live by agreement. If you take a job as a cop or a fireman for a lot of municipalities, you have to live in the municipality where you work. It's part of your contract. In some cases, and I know where I am in Springfield, Massachusetts, that's one of their requirements. But then therein goes affordability, right? If you're in San Francisco and you can't afford that, a solution like yours could really partner with teachers unions, police unions, fire unions to say, look, we want to help these working class professionals gain access to home ownership in an affordable way where there's no MI, a lower monthly payment, and just an easier hurdle to get access to a home.
Yeah. I got to drop, guys. I'm sorry, I'm having too much trouble here. Enjoy the conversation. I'll let Skye answer that. Talk to you guys soon. Take care.
Take care, Jeremy. I think that's
so many issues. It's so crazy. Like Detroit's infrastructure. If I don't know who runs the infrastructure, the telecom infrastructure, it's probably Rocket. But
Rocket Fiber was there for a while. It was a Rocket. It was one of the Rock family of companies or whatever, internet companies. But Potter is actually traveling this week. I think it's his own inability to be close to Wi-Fi. That's getting us.
We need to get him like a 300-foot Ethernet cord so he can plug in while he's outside.
Get him a Starlink.
Just a little dish hanging out behind him. But yeah, Rick, you're absolutely right. I mean, I think there's there are a lot of groups that we're talking to that have specific interest in supporting those types of communities, and then the communities themselves around teachers or other sort of essential workers, nurses, healthcare. Those are big another constituency where in healthcare you're not working traditional hours. You want to be closer to to the point of work. You're oftentimes have just different considerations around housing and challenges of being in major urban centers and the cost. So it's like 3/4 of folks of Americans still identify with homeownership as being part of the American dream, but I think it's something like 40% or less of renters think they'll actually ever be able to become homeowners today. So I think there's also just this there's a massive barrier across the board, obviously, for the folks that you're talking about, and we can all feel good about supporting them because they're supporting our communities. But it's much broader than that.
Yeah, we can compare notes on that offline at some point, Skye. We've obviously our solution's more around saving money on the real estate side of the transaction, but still a lot of the same alignment of trying to bring down closing costs for mostly first-time home buyers. And some of the groups we've signed up are right kind of in the wheelhouse of what you're talking about. Like we have a credit union, state employee credit union of Maryland, where they have very particular offers for the exact kind of people we're talking about. We're talking to some teachers, credit unions, some specific company credit unions. One of our partners is a really interesting one in DC. It's called Bank Fund CU. They basically relocate, foreign nationals who are going to be officials, economic officials or political officials living in DC for some period of time, depending on, politics.
Yeah.
And so they give them, like, most of them historically would not buy homes, but this credit union has like this very particular set of products and positioning to try to help those people buy homes. So anyway,
Yeah.
we're kind of finding a number of niches that, frankly, I didn't know existed, working in the IMB world. So it's kind of been cool to uncover, but packaging, either whether you want to think of it as affinity benefits or other ways to just get people in that first home that are in unique situations, is something that I compare notes with Potter on all the time. He's been around that space for a long time, and we're finding our way into parts of it as a real estate solution.
Yeah, that's great. I'd love to. I mean, I appreciate Jeremy's passion around helping with those things too. It's interesting for DC, sort of like, are you, used 5 years is typically that number, right? It's like you could consider buying if you're gonna be in the house for 5 years, and maybe in DC, it's sort of like, are you gonna be there for 4 or 8, right?
Yeah.
Above or below the line.
Yeah, exactly. Yeah, we have, I think, because it's sort of been like dominoes of, like, you sign one partner that looks a certain way, you know how to sign more partners that look a certain way, and word of mouth. When we did well with the first couple partners, but we have 5, I think, if not 6 local DC, like DMV, Detroit, Maryland, Virginia, not Detroit, DC, Maryland, Virginia, credit unions, and they all have some pretty, like, particular products depending on their on who their clientele are. We have a handful of credit unions elsewhere, but we've really focused on that market, kind of happened into it. And whether it's political, whether it's state employees, whether it's bank employees, like think tank type people, like the bank fund one I was just talking about, it has been interesting where they all are trying to develop different positioning and different products, and even positioning our product in different ways, how much money you can save / how much help you can get if you're not in the country, to get through the home purchase transaction, all that kind of stuff. But yeah, I love where you guys fit in that conversation as well.
Yeah, same. And it's interesting to think about. I mean, you guys bringing the transaction cost down. If the realtor changes on the buy side do bring innovation to to the transaction from a cost perspective for home buyers. I mean, if we see that sort of 6 or 8% selling cost compress, then we might also see the break even point on ownership, right, and the average tenure of holding a home actually shorten, because your cliff to be in the green is going to be much lower. Yeah,
absolutely. And especially if you pair it with other either particular local down payment assistance products, things like what you guys are building. Like, I think there's more innovation going on than I think Jeremy made the point Mike made the point in the comments at the very beginning, that there's not nearly as much conversation about all the other ways to save money on a mortgage transaction other than the real estate commission. So we've been, for good and bad, mostly good, honestly, kind of in the middle of all these commission conversations and having that conversation 10 times a day with partners and potential partners, but anticipate that you guys will have a lot of business development done for you by affordability headlines.
Yeah, I mean, like certainly, I think what we're doing, I wouldn't be doing it if I didn't think this was, a key solution in the market. But whether it's us or someone else or something else, or frankly a combination of things, because the challenge is so large here that I don't think there is a panacea necessarily, but like innovation is coming, and it's inevitable that it will come, because the trajectory that we're on is unsustainable for a huge portion of
for housing affordability.
So something's going to change. It just that part of it feels inevitable to me, that there will be innovation in the way that homes are bought and sold, that there'll be innovation in the way that they're financed. I still think that the 30-year mortgage product and a fixed rate is an incredible investment vehicle, maybe the best one in the world. And so it's one of the ways in which we're really focused on helping people still to access and take advantage of that. Because I think, again, it's sort of this, where else can you get, leverage at such a low cost, and then when rates go down, you're like, oh, great, I'll take the lower rate. And rates go up, and you're like, great, I'll keep my lower rate, right? It's just, it's an incredible product for people. And so I think, we're trying to innovate around that. But, there will be other options too. There's certainly, different rent to own scenarios that are, and products that are evolving. And I think there's a bunch of ways that we're going to get people into homes.
Yeah, when you consider companies in that space, like, who do you get compared to? Anyone? I mean, we talked about it off the top of like, you guys are in a unique space and interesting to categorize. But do you hear of other like I don't know if it's like Divvy is one that came up a lot in the headlines a few years ago, and I've spoken to about various partnerships at a few different companies that I've worked at. Do those kind of companies come up as like not necessarily competitors, but like other ways to like take a bite of the same apple, like trying to get into a home faster?
Yeah, I mean, I think everything has like when you're talking about a market that's as big as residential real estate, right? I mean, it's bigger than all public equities, right? It's bigger than the stock market. It's the largest investable class in the country. There's going to be a lot of different use cases and a lot of different products that address the customer needs. So I think rent to own has obviously a very well-defined place in the market that can provide value. I also don't think it serves everyone's needs either. So for folks that have little or very little or no capital to put down as a down payment, I think there's an opportunity with a lot of these products to in some ways create a hedge against future appreciation in the market, because you're sort of getting in, you're renting, but you have a contract around what the price of that home will be in the future that you can buy, and you've kind of got that fixed to work towards. And I think that can be really valuable for people. There's obviously in that segment of the market, some of the other benefits of homeownership may not be as valuable. So things like the tax benefits, right? Obviously, mortgage interest or property taxes. If you're not the owner, you're not taking those, right? So rent to own, those benefits. And I think in some of the cases, like, you also end up in a place where you've got to actually pay a bit more to start buying into your home, which is advantageous, but also can be challenging from a cash flow perspective. So I think there are some really great products evolving in that space. I just think the thing that I love about our model is that the interests are aligned at all phases of the transaction between the two co-owners, between the investor and the homeowner. And I, as a consumer, would be wary of a product to rent to own where it's better for the other side if I never buy, right? And I think that there are a lot of changes coming to that market, and a lot that more alignment being created. But in the past, there have been some where, hey, the company makes more money, or the investor makes more money if you never buy your home. And I think that doesn't create the right incentive towards home ownership. Not to say it's still not a valuable tool for people, but I think we want to really support everyone throughout and make sure that the outcome is a success. Yeah,
there's like some elegance and simplicity of your model by comparison. It's not like all these different things that can happen. It's just, you're going to be fully aligned in helping them purchase and then be a co-owner.
Yeah, I mean, the downside maybe is that there's while there is certainty. I mean, we can tell you down to the penny, right? Like what the outcomes will be if we know how long you're in the home and what the home price appreciation is, right? But those two numbers are variables for most folks. Maybe they have a better sense of how long they anticipate being in the home, but obviously predicting home price appreciation, we all would love a crystal ball, but you can, if you want to throw in some different scenarios, we can tell you exactly how it works out. I think the rent to own stuff, at least right? You have that, whether or not you are excited about the prospect in the future, it is contractual, and you do know exactly where you're headed, and so that can probably provide value for a lot of folks.
What lenders are you working with right now? Have you already covered that in the time that I was late to the call?
No.
I know. Do you mind if I disclose or talk about how some of the conversations I've had with Sierra?
No, go for it.
Because I know that look, part of what any sort of enterprise lender is aiming to accomplish in today's market is to sort of launch new products and to be competitive where other mortgage companies just simply aren't, or there's blind spots in other organizations. And And we feel that on the down payment assistance side, that very much is a blind spot from most companies, in part because we're all mortgage lenders are caught in the same sort of conundrum of there's 50 different state programs and a lot of different programs, even, and a lot of them even get down to the county level where there's restrictions there's all kinds of different lender restrictions that make it really difficult to either roll out, administer, or to actually help consumers in this way, because sometimes these public funds run out of money, or there's bureaucratic or administrative sort of challenges. There's underwriting challenges, operating challenges, document challenges, and so it becomes a very complex problem to solve, despite there being a significant need. And so, in the executive offsite that Sierra had yesterday, the focus really was, how can Sierra be more competitive? And there was no question that solutions like crib equity was front and center in that conversation, to say, like, we got to get this set up and figure out, either on a portfolio side, to figure out just to close this loan, earmark, I'm using sort of non-mortgage terms, but like sort of earmark the title where there's a shared equity agreement between crib equity and the consumer. And then we service it. And then generally when you service a loan, and this is good information for you, Skye, when you service a loan, regardless of how it started, if you have 6 or 9 months worth of consistent on-time payments, you pretty much can sell that asset regardless of what it is, whether it's a non-QM or whatever. Like, you shoulder a certain amount of risk up front as the servicer, but then if you want to offload that, you pretty much can sell that to another servicer almost as if it's an agency product. Because of the fact that there's consistent, the proof is in the pudding. The consumer is consistently paid on that mortgage, whether it's 6 months, 9 months, 12 months. There's a clear payment history, and so now it diminishes the risk. Like, is the consumer going to pay? Well,
right.
Clearly they are, and so you get maximum servicing value for that if you wanted to sell that or get it off your books. So I know at Sierra, I know that's an active conversation. I know we're getting signed up with Deep Haven. I know that those conversations are underway to be able to sort of partner with Deep Haven and Crib to make that happen. Is there other lenders or other conversations you're having that kind of clear the backlog of the demand for this product?
Yeah, for sure. And I think you raise a couple other really good points. But there are some, what I think of as maybe more innovative or forward-thinking folks in the space that, that want to approach this as a solution to not only creating a larger business opportunity, but also creating a larger, economic opportunity for people buying homes themselves, right? So, you mentioned Deep Haven. They've been great to work with to this point. The team at Veris has been, equally fantastic in understanding and really digging into what we're doing here. And I think, once those pieces, like as you mentioned, coming into place, will unlock a lot of the backlog that, is created by a limited appetite from portfolio lenders today. In the market, there's just only so much balance sheet that people are interested to do at the moment. But that what you also mentioned, like the risk piece of it, I find it, again, being somewhat of an outsider coming into the mortgage industry, I find it interesting that, and I ask the question sometimes around people's products. I'm like, well, if I'm going to buy a home and my parents are going to give me $100,000 for the down payment, how much do I have to contribute myself? Because I'm the one on the loan, right? And they'll say, well, is it a primary residence? So yeah, let's just say it's my primary residence, and the answer is usually zero. Right. So you've got existing products where, the borrower has to come up with nothing relative to the down payment. And we recognize that as being a viable option if they qualify for the payment. But in a scenario where we're saying that the borrower is going to come up with half of the funds, and then you have a partner that wants to come in with them to do the other half, that somehow that's a riskier, creates a riskier asset. I'm not convinced of it yet. But as we know, the proof is in the pudding as we continue to, to see ongoing performance here. And to your point about the down payment providers too, like we're just starting to make more inroads there. I think we'd love to partner with more down payment assistance providers, right? We can we can multiply the impact that they're making, right? So the home buyer is going to bring some funds to the table. They're going to qualify for a DPA program. We're going to be able to sort of match both of those things in order to create an even larger opportunity in terms of cash to close to help that transaction. So I do think it's entirely synergistic, right? It's not.
Yeah, it's so easy. But this is what's crazy. It's so easy. You take the complexity out of this for all parties, for the lender, for the consumer. It's so easy. Like if there's any down payment assistance program administrator in any state in the country, they should be calling you because they should be working with you. I mean, it solves such a dramatic problem in the industry. And it's so easy. There's no technology changes. There's no, secondary like strategy adjustments. This is truly a very easy solution to a very, very widespread problem for like hundreds of thousands of consumers across the country. It's not like there's no credit overlays. You're not saying minimum thresholds of you got to have a 660 credit score. You could do a $260,000 home or an $800,000 home. I mean, there's no. I mean, it just seems like it's a program that seems, I don't want to say too good to be true, but it's a very pro-consumer, very supportive opportunity for consumers to attain something that they just simply that's out of reach.
Yeah. I think. I don't want to say that we have no requirements. There may be a minimum, credit overlay, but there is no underwriting on our behalf, and there is no servicing requirement, right? So it does just sort of bolt on in a way that I think a lot of other, DPA programs may even have more complexity for less capital that they can provide. So we do like to think that it's easy in that regard, and that it also, I'm not aware of another sort of shared equity product that has more advantageous terms for the consumer, right? This is pro rata, and it is, in a way, like when I think about the use case of helping someone to buy sooner, right? We're really solving for time to market. You're saving for your down payment. Let's get you into that home now. And as that home appreciates, we use that scenario of the 10 years to save a 10% down payment. Well, in 10 years with average home price appreciation, that home is 70% more expensive. And so when we help someone buy, in year 4 of their journey, by the time they get to year 10, they have 200 and some odd change percent the net worth versus the scenario where they continue to save and buy on their own. And their mortgage payment also happens to be, 34% lower or something like that because they bought into the market at a lower point. And so, obviously there's some assumptions there about the market having a very linear and average progression, but the sentiment is true, right? The best time to plant a tree was 20 years ago, and the second best time is today. And if we all are here believing in the viability of the residential real estate market, then the same can be said of home equity.
What do you think there, Mr. Brock Cassidy?
I've spent the last year signing up all kinds of specialized lenders who are looking for to solve some of these problems. We talked about it a minute ago. All these specialized credit unions, all these people that are building either new types of loans for immigrants, new types of loans for certain professions, new types of loans for whether it's professions, location. I was going to say, Rick, you were saying earlier how hard it is to keep track of all the different programs, right? Kind of in your backyard in Massachusetts and in New Hampshire. I was speaking with a new partner last week, and he sent me a list of, it was like a spreadsheet of, in these cities, we have this much money that they'll contribute for this type of home. In these counties, it was impossible to keep track of. It was from Mass Housing and from New Hampshire State Housing Commissions, and so we've honestly been thinking about the same thing. And to Mike's point, we've spoken to DPR and other DPR or down payment program aggregator companies in the past too, and we certainly haven't solved it from the real estate side, but it's been really interesting to every time you meet someone that really knows their own niche, really knows their own region. They tell you about 10 county programs, 5 state programs, and 20 city programs. And there's no way that at a national level, most people know how to navigate that.
No.
Whether most people means realtors, whether most people means lenders, whether most people means, companies like what Skye and I are working on. So there really is some opportunity there to bring that in platform somewhere or in multiple places.
Now, are you guys working together at all? Well,
not yet. I mean, we've talked about it. We want to talk about it. And
like, why wouldn't you make that sort of an easy? Because it's not like there's some complex technical integration. It's a matter of just providing, crib as sort of an option within an existing communication link that you currently have between the realtor and the loan officer and the consumer. You know what I mean? Just to have we haven't talked yet, because I also want to deploy you guys at cross country too, right? But I want you to deploy you guys at Sierra, and we just haven't really talked about it just yet. But like, is there a dashboard that the loan officer or the consumer logs into that controls not controls, but kind of guides the conversation between the realtor, the consumer, and the loan officer that you provide?
Yeah. Yes and no. I mean, so there obviously has to be kind of separation of church and state between like the actual lending choice and the real estate experience. So even like our real estate credits come in, not in the lending decision, but on the closing disclosure. So it's we can't fully, I don't want to use the word steer in case CFPB is listening. We can't fully. We can't fully like deploy it as an option from our platform, but we can definitely
select
our existing partners and put it, and we can give consumers the option of opting into it and things like that.
Of course.
Right? Sorry.
No, of course. I mean, as long as the consumer opts into it, you're not steering it. The consumer can steer themselves, right?
No, that's what I mean. So like there's tons of fertile ground here. It's just we haven't figured out the client experience on how it works. The best thing to do would be to find someone like Sierra or we'll compare notes on who else we're already working with, and say, all right, we have a mutual partner. We're having conversations at these same points. Let's connect the two. So that's probably our best case, is to kind of either co-sell lenders together or compare notes on who we're both already working with. But there's no doubt that, I mean, it's come down a little bit, but historically NewZip's working with 80% first-time home buyers. Since we launched NewRez and a few other servicers, we've been doing a lot of sell transactions as well. So now it's more of a mix, and obviously just repeat home buyer. So now it's probably closer to 50% first-time home buyer, but it's still like, that's our positioning, our branding, our niche is largely around helping people that are struggling to buy homes to buy homes. So it's definitely a good opportunity.
That's great. I love, Rick, you're in the screen here. You're in the middle, sort of, literally and metaphorically making connections here.
Well, look, if it benefits the consumer and it really moves the industry forward, like it's a connection that's worth. Yeah, it's really a connection that's worth making. I mean, if it just adds more complexity, then it wouldn't make any sense. But
it's super well aligned with, I think, what we're both working on. And obviously I've done business before with Bill Walker and other folks on Skye's team, so that helps things along too. Yeah.
We've got another call maybe off the live feed to follow up with.
Yeah. Well, good. Well, look, I appreciate the opportunity and the time to talk with you. Obviously, I'm a big fan of Cribs. I think it's a phenomenally innovative pro-consumer solution to a very widespread problem, and so I love this conversation. Apologize for the technical difficulties for me joining a few minutes late, but I'm glad that you were able to make the time to join us here and advance the Real Fridays conversation.
Yeah, likewise. I appreciate the invite, and also I'm not so sure it's not because you're on the West Coast here, so you're just getting an early start to the day, like most of us for the show.
Yeah.
Rick slept in this morning. That was the real.
Because my hair.
It's 5 p.m. for you guys. Yeah,
oh God. No, you're such a savage. No, it wasn't it at all. It was actually just purely the technical issues with the Citizen Hotel here in Sacramento. Phenomenal hotel too. I recommend it highly. It's a nice little boutique Marriott sort of autograph collection hotel. But
did they sponsor this episode, or was that someone else?
No, typically we only have alcohol sponsors.
Oh, okay.
So typically it's an IPA.
I don't have anything within reach, or I'd plug it. But yeah, usually Rick has some hazy IPA. Yeah.
So we'll talk to you guys soon. Thank you so much.
Sounds good. Thanks for coming on.
Thanks, guys.
Yeah.